personal loans, credit cards, and consumer durable loans. That today is about 6 to 7% of the Indian economy.
Oh, wow.
Just these three categories is $250 billion. It was not always so. Explosive growth in our part of the economy, but which has a huge multiplier effect on the rest of the economy as well. Insurance is essentially taking money from the present and putting it in the future. Credit is taking money from the future and putting it into the present. Indian housewives own more gold than Fort Knox times 10 or something like that. There are thousands of NBFCs in India.
Hello, everyone, and welcome to another episode of Ask InCred, where we discuss all things finance, from fintech to stock markets to careers in finance and more. Joining us today for a deep dive into the consumer finance space is Prithvi Chandrasekhar. He is one of the founding members of InCred and the CEO of InCred's consumer finance business. With nearly 3 decades of experience, he has held leadership roles and worked internationally at reputed firms like Experian, Capital One, Accenture, and McKinsey. At InCred Finance, more specifically, he manages the personal loans portfolio, which is over 6,000 crores in loan book with a best-in-class NPA ratio of 0.8%. With 25 years of his professional experience spent in advanced analytics, you could say he's the brain behind all the complex risk algorithms that tell us who to lend to and at what rate. In short, he's the human form of what machine learning and AI together can't achieve. So, without further ado, welcome to Ask InCred, Prithvi.
Thanks, Radhika. Great to be here.
Fantastic. So, Prithvi, in this episode, the intention is actually to just understand the overall consumer lending space in India. Perhaps you could also share some of the nuances that not many of us might know about, and also how the space has evolved over time. So, could we maybe just kick off with some top line numbers that you would love to throw at us?
Yeah. Consumer lending in India is huge. And when we understand that, it's important to remember that it was not always huge. Right? So, consumer lending in India, which I'll define as unsecured consumption lending, which is basically personal loans, credit cards, and consumer durable loans, that today is about 6 to 7%
Mm-hmm.
of the Indian economy,
Oh, wow.
right? So, if we say we are approximately a $4 trillion economy, just these three categories is $250 billion,
Wow.
right? It's huge, not just in absolute terms, but relative to equivalent benchmarks in other countries, right?
These are the developed countries you're
Yeah, so like the US and the UK, which are both culturally much more credit hungry markets
right.
than India, would be in the same range, 6 to 7% of GDP,
Wow.
right? Now, it was not always so.
Mm-hmm.
And it was not always so in the very recent past, certainly in my reckoning, because in 2015, the industry was less than an eighth
Okay.
the size of where we are now, right? So approximately, give or take, not $250 billion, but more like, 25 billion.
Wow. Wow.
And so since 2015, as an industry, we have doubled and then doubled again and then doubled again. So that's
Wow.
2 to the power 3, so 8.
Crazy. Yeah.
And it's actually more than that. It's bigger than 8x,
Wow.
right? And this has been one of the drivers of the fantastic growth we've seen in the Indian economy
Mm.
in the same period, right? So, as you mentioned in the introduction, I actually worked abroad for several years. And I came back to India about that time, about 10 years ago. And at that time, the InCred pitch deck and the pitch decks of many other companies coming into consumer finance started with a slide about how India is a underpenetrated market compared to any international benchmark. We were credit starved.
Wow.
Now that's no longer the case.
Correct.
And this has happened in a short span of about 10 years. And that's actually thanks to foundations that were laid in the previous 10 years.
Mm-hmm.
Nandan Nilekani is probably the one visionary I would call out as the person behind the India stack, whether it's Aadhaar or the credit bureaus or the Sehmati account aggregator framework or Udyam Aadhaar or the penetration of telecom, the near universal access to telecom, other initiatives which have taken root like the PMJDY, the Pradhan Mantri Jan Dhan Yojana.
Right.
All of these have come together to unlock this explosive growth in our part of the economy, but which has a huge multiplier effect on the rest of the economy as well.
Fantastic.
And so that's where we are today. What you'll also notice is that that slide which all of us presented in 2015 is no longer true. But that doesn't mean the growth is over, right? And we'll talk more about what shape it takes now.
That's great. That's great. Yeah, but has this growth largely come from the tier one, tier two cities, you think? Or is it more, spread out across India?
Uh, it's spread out across India. This is unambiguously the case.
Nice.
We can actually see very clearly in public data, whether it's RBI data or credit bureau data, where the growth is. And it's across the length and breadth of India. Also, the nature of this growth is its consumption finance, right? So, what's the money being used for, right? Home renovations, uh, right? White good purchases, mobile phone purchases, healthcare, particularly for elders, given that we're a very underinsured country, right? Repairs following events like the floods in Chennai and Kerala. Again, we're an underinsured company, and credit is the mirror image of insurance and
fair.
has a very big role to play in an underinsured economy like us. So, this is money that can seem very abstract until you put it down to, my home got flooded in, unprecedented rains. And I've got to redo the kitchen and redo the furnishings. And where do I get the money from? It's not from insurance, it comes from credit.
And that's a very interesting point. Yeah, one wouldn't correlate it with the penetration of insurance, but there you've said it. I think that makes it so much more important in terms of having access to credit when you need it, right? Especially when they don't have something like a fallback of an insurance.
Absolutely. Insurance is essentially taking money from the present and putting it in the future. Credit is taking money from the future and putting it into the present. It's just the mirror image of the other.
Love how you put that. Fantastic. I would in fact ask you on the lines of the same kind of growth of consumer finance in India. Do you see it particularly focused in certain products? Overall, if you look at loans, whether it's credit cards or personal loans or auto loans, like is this growth across all the product verticals, or is it centered around a few?
Great question, and it's not as evenly spread out as we should be seeing.
Okay.
So, unsecured consumption finance has seen this fantastic boom where we are, at about Western market levels in terms of penetration. Secured instruments have not seen an equivalent boom. They've grown, but if we've seen a CAGR of 25% on unsecured consumption finance through COVID, through ILFS crisis, through
Right.
demon, through all of that stuff, we've had a 25% growth rate. The growth rate in secured has been at least 10 points lower,
Oh my.
right?
Okay.
And that is not for lack of intent. The reality is everybody doing credit would love to take a bigger bite of secured. However, the foundations that we've built for unsecured, the India stack,
Right.
which I spoke of a minute ago, we don't have equally deep foundations for secured.
Oh, that's interesting. Okay, I would have never guessed that. Okay.
Yeah. It's actually a very obvious point, right? Land and property ownership records in India are nowhere near as digitized as, say, the credit bureau or banking.
Right.
For that matter, even GST, which is somewhere in between, hasn't yet had the impact that, say, a visionary like Nandan would have liked to see. Uh, Simply because the quality of data available there and the analytics that run on that are not yet quite up to the mark. I don't think that's more than 3 years away, but we're not there yet.
That's a very interesting point. Yeah. So there's a lot to do on the other side in that sense, in terms of digitizing all of these records when it comes to physical assets.
Absolutely.
Yeah.
Absolutely. And my view is that that will be needed to catalyze a more balanced growth of the credit ecosystem in the next 5 to 10 years.
And I think perhaps that's one of the reasons that gold loans is so popular, because it's so easy to just value it on the spot and give it.
It's a very good point, right? Because there's a lot of research on gold in India and why Indian housewives own more gold than Fort Knox times 10 or something like that, right? But it's actually for a very good reason, which is that gold is access to credit when you need it.
Interesting. Um, Now let's come to the subject of NBFCs. Right now, there's been a lot of regulatory scrutiny in the last 12 months, and as a result, we believe that loan disbursals have declined by 5% in the last year. So all of these tightening of controls and additional risk weightages, do you think that this trend will continue going ahead, or is there more to it than meets the eye?
I don't believe it'll continue very long. And the reason is the Indian economy and the Indian people need that growth. We need the GDP to continue to grow at 7+%, for which in real terms with 5 percentage points of, say, inflation, so 12+% in nominal terms, and we'll need credit growth to be higher than that to support that real GDP growth, as is natural. So the moderate kind of middle of the road estimate for where should credit growth be might be 15 to 18%. We may not go back to 10 years of 25% plus CAGR,
Right.
and I don't think we will. But the decline won't continue long. And I think when you see the headlines about the decline, it's very important to read that with the backdrop of 10 years of breathtaking growth
Right.
that
Correct.
preceded that decline. With a small correction, credit to the RBI, they called the top of the market, raised the risk weights on unsecured. They effected the slowdown that they wanted. And I now expect continuing growth, but not at the breathtaking pace that we saw in the last 10 years.
Interesting. I remember I think about a year back or so, we had this conversation on the small ticket loans, right? For our viewers, could you just explain the whole, idea of how they are the ones which are riskier as compared to, the fairly larger or average ticket size loans, and how the strategy of InCred or an NBFC can be structured around that?
Yeah. So, what the industry calls STPL, Radhika, small ticket personal loans,
Right.
it could also be short term personal loans.
Okay.
Uh, this is a phenomenon that we had not seen for a very long time. Maybe it started 10 years ago, not older than that, and really took off
Mm-hmm.
after COVID. And this enabled credit access to tens of millions of Indians who were previously not in the formal economy, right? How did this happen? Because these products were underwritten uh, on a very light touch basis, purely digitally. A term that you will hear industry people use here is bureau surrogate underwriting, which means we do the KYC, which is mandatory as per RBI, and we also check the credit bureaus to find out what credit history this loan applicant has. And with maybe a couple of other low friction digital checks, a small ticket loan is extended to the customer. This is super useful to the customer.
Right.
Right? There is a genuine demand that this product meets.
Correct.
Especially in a macro context where credit cards, which are the first credit instrument that an end customer has in most economies, is actually still underpenetrated in India. So an STPL became the first point of entry into the formal economy for a lot of the emerging India.
Okay.
Right? My belief is that the need for this product continues to exist, but the problems that have happened in this segment, essentially through risk being higher than it really should be, is the result of uh, perhaps insufficiently diligent underwriting.
Okay.
I'm saying perhaps because there are hundreds of players in this space. Some are very responsible, some are not. I don't want to paint an entire sector of the economy in one color.
Right.
But there was some maybe less than appropriate underwriting that happened there. That's correcting as we speak. Where is this going? I think the product will be a part of our landscape for a very long time, and that the underwriting standards used for this product will continue to improve.
Fair.
For example, account aggregator,
Right.
which is an infrastructure that allows us to read the customer's bank statement digitally with perfect consent and very low fraud risk in terms of data manipulation, right? Makes it possible to offer the low friction journeys that made STPL popular, right? Without taking the same kind of credit risk that previously was necessary because the AA infrastructure was not mature enough. So I actually think STPL is great, especially in an economy where credit cards are underpenetrated. In fact, the regulators are promoting RuPay now, which is great because that's, again, an access to credit market product. But I think the underwriting standards associated with that product will increase over time.
Nice.
By the way, this is not a segment that we played a lot in as InCred.
Okay.
Because wearing my risk hat, I never got wholly comfortable with the underwriting standards.
Like I said, you are the human equivalent of machine learning and AI put together. I don't even know if they're two different things. I think they're the same. But like you keep saying, right? I think, since we're talking about that, uh, coming back to the point that, that we are still seeing a decline in the growth in the last year, and it has kind of slowed down. What are the ways in which NBFCs are coping with this to recoup their, growth?
There are thousands of NBFCs in India.
Yeah, what's the number like? I think what 9,000 the last.
Yeah.
Or 10.
The RBI records approximately 10,000, slightly under 10,000. So there are lots of players in this industry, and pretty much every one of them will have a different strategy.
Okay.
That said, I can tell you what we're doing, which is we are doubling down on what has worked well for us. We're actually not slowing down. We've stayed the distance in terms of our growth targets and our dispersal targets and our AUM build targets. We don't think this slowdown is because of a macro shock.
Okay.
It's more to do with the supply side, with other players pulling out of the sector. The demand for credit is as strong as it's always been. You can see that in the booming demand for like gold loans. That hasn't gone away.
Correct.
And we think the important thing is in this time to continue to underwrite diligently when we're booking new loans, which we do and have always done. But for an NBFC like us, and we are not alone, there's several NBFCs which are very risk-centric. The slowdown actually presents much more of an opportunity than a threat, right? I think for NBFCs which did not have the same risk capability, which were, say, over-reliant on bureau surrogate underwriting, or maybe even in-person or subjective underwriting, there may be more problems in kind of coping with this decline in industry volumes.
What would you think should be the strategy on, the secured loans portfolio? I mean, just logically thinking, one would reach a conclusion that, shifting to or increasing your ratio of the secured portfolio might be a better bet under these circumstances, assuming that they are safer in terms of their nature. Would that be wise?
No, Radhika, I think you touched on the most important point there, which is assuming they are safer. Right, and I'll come to that in a minute.
Yeah, because you always think, I mean, you can sell the asset and get your money back, right? That's the assumption.
That is the assumption. I'll come to that in a minute. Secured didn't actually protect the banking system the way many people assumed it would.
Then where will the competitive advantage lie in risk analytics?